Welcome to the Allan Small Financial Show. Thank you for taking time out of your busy day and spending it with us. I know this time of year can be a little stressful. We're nearing the end of the year. Kids are having their winter concerts at school. Obviously, work is always busy, and we're all running around shopping for the holidays. I know that can be quite stressful. Seems like this time of year, everyone's is running and has somewhere to go, somewhere to be. So if you are watching our show today, thank you. We appreciate it. I think it's going to be a great show. We have a lot of educational pieces. We're going to talk about macro, the micro, what that is. We're going to talk a bit about possible year-end rally, Santa Claus rally, as we call it. So a lot of important information for you, the investor, to take home with you before you make your investment decisions. So this week, what I like to do is talk about a number of different things. Some of the things we have not spoken about in quite a while. We're going to touch on Canadian banks. Are they a good investment? I've been talking about Canadian banks probably for most of my career as the core or the cornerstone of my portfolios that I've built. Are banks still considered a good investment at this time? We'll also do the usual This Week segment, which talks about what individual investors need to consider before they make their investment decisions over the next couple of weeks. We're also going to talk about, as I mentioned, are we building a case, or is the market building a case for a year-end rally? I'm sure investors would love to have a nice Santa Claus rally. We often see it, more often than not. Are we building a case for a year-end rally? And an interesting topic that has come up in my conversations with individuals over the last week or so: are the changes in the market happening so fast that the average retail investor, all of you watching today, is it very difficult for you to keep up to date or keep track of what's going on? Are you falling behind? And perhaps is that causing you to perhaps make some poor investment decisions? We'll touch on that as well. And lastly, offensive and defensive stocks. What are they? Can you be offensive and defensive when you choose an investment? Well, I'll talk a bit about that. And always my favorite topic, your questions. If anyone has any questions during the show, please put them in the message box. I'd be happy to answer them at the end of the show, as I do each and every show. So Canadian banks, it's something, as I said earlier, I've spoken about really my whole career. Living in Canada, you can't help but to own a bank or own a mutual fund that owns bank stock in it. Canadian banks, the 5 largest banks, and I guess 6 if you count National Bank, really are the market for banks in our country. Very different in the US that has, something like 500 or 700 banks down there. Really, the 5 largest banks here in our country have pretty much most or all the business. So our banks, kind of the 5, have a bit of a monopoly on banking in our country, and they've always seemed to perform well. If you look at any chart of any bank, and we're going to show you some one-year charts, but if you looked at a longer-term chart, a chart of over, say, 50 years, you're going to notice that the chart pretty much goes from the bottom left to the top right. Banks have always paid a dividend to investors. So if you are an investor that owns bank shares, you're going to be making some money. The bank's going to pay you some money out of their profits in the form of a dividend for you. That dividend has never been canceled, even in the darkest times for our economy. 2008 comes to mind, where all the banks in the US struggled. Canadian banks struggled as well, but they still maintained their dividend. And as we know, Canadian banks usually increase dividends once or twice a year, either the first quarter or the fourth quarter or whatever quarter it may be. I know recently Royal Bank has made an announcement that they're increasing their dividend. So banks have always been a very good growth and income type of investment. The banks just reported earnings recently towards the end of November, beginning of December. Overall, their earnings were okay, I would say. Nothing tremendous. As we start to see Canadian economy and the North American economy slow down, you're seeing a slowdown in the banks. However, a bank like Royal Bank, which I believe we do have a chart of, you will see that Royal Bank chart showing that Royal Bank has done extremely well. It's probably been the best performing Canadian bank. Their earnings came in above expectations. TD also came in above expectations as well. Names like Scotiabank, which we have a chart up as well, struggled a little bit more. They had mixed results. Scotiabank is probably the most diversified bank, meaning they have a lot of business outside of Canada, outside of North America and Latin America, South America. So they're definitely their stock price will move with what's happening in that part of the world. But you can see Scotiabank stock towards the end of that chart really starting to tail off. And lastly, CIBC. They probably had the most disappointing earnings over all the Canadian banks this past quarter. And you can really see a tail off in their share price. Now, as I always say, what goes down probably comes up at some point in the not so distant future. And usually what you'll find is the bank that performs the weakest or the worst in one year tends to be the outperformer the following year. And some of our banks, like a BMO, for example, which we didn't show a chart of, or a Scotiabank, or a CIBC bank, are trading at very cheap multiples. Bank of Nova Scotia is paying a 6% dividend, CIBC a 5.5% dividend. And these are great stocks to own, in my opinion. So looking at the Canadian banks in general, are they good? Are they a good investment to have in your portfolio? I think they are. I think you can get into a Scotiabank at this time, down about 28% from its previous high. And I think that 6% dividend is going to be great for your portfolio. On a quarterly basis, you're going to receive a nice payment into your portfolio. So I think there's a lot of growth to be had as Scotiabank shares bounce back, and a consistent 6% dividend, and that will only go up over time. So as part of a core holding for any portfolio looking for growth or income, I think the Canadian banks definitely fit the bill. So this is the part of the show where I talk about what I believe is important for Canadian investors, or any investor actually, to consider over the next couple of weeks before you make your investment decisions. As you see here, we're going to talk about the current economic environment. What's going on out there? Obviously, things are changing seemingly on a day-to-day basis, not even week-to-week anymore. Things are changing from one day to the next. We're also going to talk about the current, so that's the current economic environment. We're going to talk about the current investing environment. What's going on with the individual corporations themselves? Are they cheaply valued? Do we see a lot of growth there to come? So we're going to look at the individual stocks themselves. And lastly, what I think you need to consider before you make your investment decisions are your investment objectives and time horizon themselves. What are your investment objectives? Are you looking for growth? Are you looking for income? And what's your time horizon? Do you need all your money in the next 6 months because you're going to go out and buy a home? Or is this money you're going to be investing for the long term? So let's get started. Current economic environment. Now, you see here, that's the macro side of things. So it's looking at what's going on in the world from 30,000 feet in the air. And as I've said, things are changing so rapidly. Just look at China, for example. They go into a COVID lockdown. They come out of a COVID lockdown. They have a zero COVID policy. Today, they announced that they're relaxing that policy a fair bit. And so the market tends to move with what's going on in China. China is the second largest economy in the world. So of course, they're going to have a big influence. The market obviously moves with what's going on in the Ukraine. Obviously, Russia-Ukraine situation has been with us for many months now, and we seem to perhaps not focus as much on it, but make no mistake, it definitely is changing the macro environment. Most recently, there's been a cap placed by Western nations on the price of oil, that oil can be purchased from Russia, $60 a barrel to be exact. We're also hearing about now the West has fully stopped or has not purchased or will not purchase oil from Russia going forward. So there are a lot of things going on with the Russia-Ukraine situation. Let's not leave out the Federal Reserve, the Bank of Canada. Bank of Canada today raised interest rates 50 basis points. And I think we have a chart with respect to that. We're looking at the recent data showing bank rates moving higher, interest rates moving higher. And that obviously plays a factor. It was interesting. I was making a comment this morning to someone talking about the 10-year bond rate and how as the 10-year started to fall in terms of interest, the market actually liked that. And when it started to rise, the market doesn't like that when interest rates move higher. Well, now the 10-year government bond rate in the US is about 3.55%. You would think the market would be rallying on a lower 10-year because that 10-year rate used to be above 4%. The market actually is taking it in stride. It's not even moving now. So that environment has changed. No longer is the market looking for the 10-year as an indication or as a guide to whether it should go higher or not. It's looking at other things. So the macro is definitely playing a big factor and something individual investors should consider going forward. Let's move to the micro. What is the micro? Well, that is the analysis of each individual corporation. That is the analysis of PE ratio, so the price of a stock versus its earnings, looking at what that company has done, where it's trading relative to itself and its peers going forward, its history of its stock price. And again, you can start with Scotiabank. Scotiabank trades at around 8 times earnings, very cheap historically to itself. That stock usually trades at 11 times earnings in that range. Again, as I said, paying a 6% dividend. So that might be something that gets people excited. When you look at the stocks with low PEs, you can look at even US banks, such as a Citibank, trading at, again, 6, 7 times earnings, historically a lot higher than that. Citibank also pays a 4.5% dividend as well. So there are a number of stocks that I think you could look at from the micro side. Fundamentally, how are they performing? And look to see, well, are they cheap? Do they still represent good value? Is their story still intact? The reason why you bought them originally, is that story still working? Can you say with certainty, if I buy this stock, it's only a matter of time before this stock rises because the company's doing well? It's just factors beyond their control for the reason that their stock prices decline. But when you look at PEs, when you look at the price versus itself, when you look at cash flow, if it's a company paying out a dividend, a lot of the oil companies, what you want to look at, some of them are paying outrageous dividends. Devon Energy, Pioneer Natural Resources, companies paying 7, 8% dividends. Pioneer 11% dividend. Is that dividend intact? Can that dividend be cut? Or do they have enough money to continue to pay that dividend over time? These are the things you want to look at on a micro level. So you want to look at the macro to see what's going on in the world and be able to tell where you want to put your money. And then you want to look at that's the macro. Then you want to look at the micro. Where should you be looking? Individual names, individual investment ideas, bonds or stocks. You want to take a bottom-up approach. And lastly, but not least, you have to look at yourself in terms of what are you looking for investment objectives? What's your time horizon? Are your investment objectives growth or income? I had a client a few weeks back say to me, Allan, you know what? I don't need any income right now. If I get income or a lot of it from my investments, it's going to put me into another tax bracket. So I rather buy investments that are going to make me capital gains, which are taxed better, than ones that are going to pay me dividends or interest, which is going to increase my tax that I need to pay come April. And then there are some clients that want to live off the income that these investments provide, that steady dividend or that steady interest that bonds provide. So they're looking for more income. And then you have clients that are, or investors looking for something a bit of both, dividend growth and capital gains. So growth and income. So investment objectives really is important to figure out what you're looking for. And lastly, time horizon. How long are you going to be investing? One of the biggest mistakes investors make is they feel as though, once they approach retirement, and I've spoken about this on previous shows, that they don't have a lot of time to invest in ideas that may go up and down. They want to just buy something that is more safe. And that is fine. When I say safe, I mean interest-bearing, lower risk type of investments. And that is okay. But make no mistake, once you start investing, you're pretty much going to be investing for the rest of your life. I don't really know anybody I can think of in my 25 years, other than if they had to buy an item like a house or something like that, where they used all or the majority of their money all in one shot. Usually you pull money out of your investments gradually over time. And whether it's a few $1,000s a month or a few $1,000s a year, and that's what you use to live off of and enjoy life in retirement, but the rest of your money stays invested. And so investment objectives, time horizon, you mix that with the micro and the macro, and that really should be what all individual investors should focus on over the next couple of weeks as we head into year end, as we head into hopefully a Santa Claus rally and into the new year. So for the first half of this year, we had a market that really was the worst market we've seen since 1970. So we're talking 50 years, and this was the worst we've seen. And that goes with 2008, where we saw a really difficult market. This was a negative market, and it lasted pretty much for the first 6 months of the year. The low point, or one of the low points for the year, was at the end of June. And another low point we saw at the end of September, beginning of October. But over the last, let's call it month and a half, 2 months, we've seen a rally. And if you look back to where the market was on July 1st and compare where we are today, most investors will be higher today than they were on July 1st. So we've seen markets and investor portfolios rally. Now, obviously, it depends on what type of investments you have in your portfolio. But overall, I can safely say I believe that most investors have had a positive second half to the year. So will we end on a positive note going into the last few weeks of December? I think it is very possible. Why do I believe that? And why do I believe the case is building for a year-end rally? Well, I think the market is starting to come to grips, or has already come to grips, with all these interest rate increases, with a lowering or a slowing of inflation. Inflation is coming down, albeit very slowly, both in Canada and the US, but it is coming down. I think the central banks in the US and in Canada are talking about slowing down the pace of interest rate increases. We had a chart earlier showing that the pace of interest rate increases. I think we have another one that shows how steep interest rates have gone up. And you can clearly see that it took a while for the market to digest it. At this point in time, we're looking at the last 3 weeks of the year. We could see some capital loss selling. We could see some selling because people want to write off their losses against their gains. So you might see some selling over the next week or two. But overall, in my opinion, I think this market will gain some traction once we get through. We saw today, Bank of Canada raise interest rates 50 basis points. Definitely expected. So the market really didn't have a negative reaction. And in fact, had a bit of a positive reaction to what's happening with respect to interest rates. I think we have a chart showing the December Santa Claus rally and how good the month of December actually is. You see all the graph that shows all the months. There it is. What Santa Claus rally actually means and what it is, and keeping track over the last many years. You can see December is the best month of the year. November is not bad. October is one of the top months as well, as you can see here. So the last quarter of this year tends to do well. And if I'm right, and if investors and the stock market has already factored in another 50 basis points by the Federal Reserve in the US, and perhaps another 25 or 50 in the new year, and they pause, like the Bank of Canada said they may pause after this hike, or maybe one more, then I think you could see a rally next year for the markets. Maybe not initially over the first couple of months, but I think as the year moves forward or moves on, 2023, I think the stock market will move higher. So I think it's going to start this month of December. I think we could see a good last couple of weeks, and I think we'll see what 2023 brings. I expect companies to talk about how things have slowed, how the consumer has started to slow down, although the consumer is still pretty strong right now. But once we get by maybe the first month or two, I think this market can really gain some traction, and we should have hopefully a positive 2023. So one of the questions, or one of the things I always tend to think about when I talk to individual investors, especially around statement time. Now, when's statement time? Well, usually individual investors receive a statement probably midway through the following month. So your September statement comes probably mid-October. It takes about a week or so to gather the data. The printers that print the statements usually come back and have it ready to go for the second week of the following month. For those that receive a statement online, then you might get it a little sooner. But I always talk to individual investors about looking at what their portfolio represents, or discussing what they're seeing and what is actually happening right now on the ground today. Often an investor will call me up and say, "Oh my goodness, especially after September, which was one of the worst months that we've seen in years, actually." I would get a call mid-October, and investors are saying, should we be moving out of the stock market? September was such a bad month. Perhaps we need to change things. Things aren't working. And then I turn around and say, do you know what you're doing in October? You know how good October was? And actually, October this past year of this year was fantastic. One of the best Octobers we've ever seen. One of the best months for the market in general that we've ever seen. So you had the worst month, September, followed by the best month in October, which is usually the case. Best months follow the worst months. Best days follow the worst days. But for the average retail investor, it's sometimes difficult for you to keep up with how fast your portfolio is changing, how fast the market is changing. So when you're reacting to statements or data that has come out, released by the media, for example, that data is in the rearview mirror. That is sort of old data. We want to look at where things are going. As Wayne Gretzky said, you want to look at where the puck is going, not where the puck has been. An hockey analogy for those hockey fans out there. So you want to look to see where things are going. And so I often send out emails or talk to clients, and my conversations are, right now, I understand you've seen a difficult statement from the previous month. Let's talk about what's going on now. October, for example, is a great month, and you should be actually feeling better about how your portfolio is doing. And we have a few charts, I believe, just some general charts, S&P 500, TSX. Let's take a look at the S&P, and you'll see here what I mean. The peaks and valleys are extreme. Look at the fall off at the beginning of October, and then a rally kind of halfway through October into November and up into the beginning of December. So if you were someone looking at a September statement, or even looking at your account mid-October, you probably would have felt really bad. But if you then looked at your portfolio 2 weeks later, a month later, 6 weeks later, you would have noticed an amazing run in the markets, and probably, if you're in an equity portfolio, an amazing run in your portfolio. And you'll see the same thing. I think we have one of the TSX. You'll see the peaks and valleys as well, very pronounced. Look how volatile this chart is. And it makes it difficult for individual investors to comprehend, right? We're always looking at our latest statement, and sometimes it's hard for us to figure out or understand how their investment advisor, let's say myself, is talking so positively about the markets when all they're seeing is doom and gloom from a previous negative month. So keep in mind, when you look at your statements, when you look at what the media is saying, what you read in the papers or online, keep in mind that a lot of times that's backward looking or old data. You want to look at what's going on now and look forward. And that is the best way to be, especially if you're an investor considering making an investment into the market or into any investment in the near future. So this is a topic that I like to discuss, a topic that comes up quite often. I called it offensive and defensive stocks. It's basically investment ideas that I think you could own because you want to take advantage of the market, but also ideas that you could use or buy into that if the market were to fall further, it will protect you to the downside. So play offense and play defense, depending on the type of portfolio that you have, your investment objectives, etc. So how can an investment do this? Well, very simply, an idea for an offensive type of investment would be something that's going to give you growth, something that has fallen tremendously over the past year, let's say. And I think we have a chart of Amazon, for example. Stock of Amazon once was over $180 a share. Now it trades, as you can see, about $88. So I think it's a great time to own a name like Amazon. Of course, if you can handle the risk that comes with owning obviously a volatile name like Amazon. Obviously, Amazon, one of the largest companies in the world, a company that we all know, we've all come to know very well, especially during COVID times, getting those Amazon packages. But I think a name like Amazon is also good for defense. Why do I think that? Because it's fallen more than half its value. Now, if you do a price to earnings analysis on Amazon, it's not going to be 8 times earnings like Scotiabank or 6, 7 times earnings like Citibank or some other stock. It's going to have a higher, what we call PE multiple, or a higher multiple that the stock is trading at. But when you look at how far this stock has fallen, and you look at why it has fallen, and one of the reasons why it's fallen is because their expenses were a lot higher over the past, let's call it 6 months, than they would have liked. They spent a lot of money building out their infrastructure, all those buildings, all those centers that help prepare the gifts and prepare the items and ship it to you, the fulfillment centers. They needed a lot of those during COVID times, more than before. And now that everybody's back, or most people are back in the malls and going to shops and face to face and shopping again in person, Amazon doesn't need as many workers or fulfillment centers. So they're working on cutting costs. A lot of people think, oh my goodness, they're laying off workers. That's not a good thing. Actually, in the case of Amazon or even a Facebook or Meta, it is a good thing, because these are the types of companies that got really large during the COVID years, those brief couple of years, and now they need to right size, not downsize, right size their business. So a name like Amazon is a name I think you could play offense with. When market goes higher, I think Amazon will go higher, but also I think there's some downside protection because the stock has fallen already. Another name that I guess in a space that you could take a look at, something totally different, would be something in the semiconductor, a chip maker, an AMD, for example. I think we have a chart of AMD stock as well. Now, AMD is a name that is considered on the higher risk side. It's a little bit more volatile, but it is a name that has fallen by more than half its value once again. So if you're looking for a tech company that has the potential to move significantly higher, again, doesn't pay a big dividend, more for growth, I think one of the best semiconductors or chip makers is AMD. They're in many different areas, many of the hot areas of the market, whether it's gaming, whether it's automobile, whether it's artificial intelligence, you name it, they're there. And again, I think you can play offense because a name like that will go up significantly in good markets. But I think it's fallen so much that it gives you some downside protection. Lastly, I think you want to take a look at names that, as I mentioned earlier, a couple of the names like Citi and Scotia, names that are cheap. So names that give you or are trading at very low multiples. Names that, like a Scotia, again, I always come back, as you can see, one of my favorite names is Scotiabank at this time, because it's going to pay a good dividend, trade at 8 times earnings. And again, I think it's going to go up. It's down 28% from its highs. I think it'll go higher. It has higher interest rates are going to help the banks. So that's a positive, but I think it has downside protection because of the 6% dividend, because it's trading at 8 times earnings. I think a name like that can give you some downside protection and will give you significant upside. So when you're trying to look for names that are going to give you upside and protect on the downside, I think you want to look at fallen angels. Disney would be another one. I think we have a Disney chart there. Disney's another one that has fallen by half. Again, maybe not trading at a low multiple, but new CEO, Mr. Iger has come back. I think the future is bright. The former CEO did things a little differently. The market didn't really like that and punished the stock over the last year or so. So Disney's a name. AMD is another name. That Amazon is another name. These are names that have fallen so much that I think you can take a look at them, provided you're okay with the risk of owning names like that. And then you can take a look at cheap names, some of the banks, some of the pharma companies, perhaps some of the retailers. These are names in sectors that right now are trading cheaply on a PE basis. And if you can get a dividend as well, like a Scotia, while you wait for the growth, that is a great recipe for success. Now we come to the part of the show that I like, and taking your questions, because really your questions and your comments that I get throughout the week and comments from my clients is, what the information or the meat and potatoes, of this show. This show is all about answering your questions, getting information out to you, as I said at the beginning of every show, so that you are well equipped to make individual investment decisions. So I see a couple of questions here. We have a few minutes to take a few. So here's a question. Hi, Allan. Am I better to put down a payment on a house, pay off my student debt, or start investing in the stock market? Do you ever help your clients make these decisions? I guess the quick answer is I help them make those decisions all the time. Whether you pay off debt or not always comes down to the interest rate. And as we know, for those that had a 1-2%, let's say, variable rate mortgage, or a line of credit was really low interest, where money was free at the start of this year, money's not free any longer. Those variable rate mortgages are 2-3 times, or say 2.5 times higher than they were at the start of the year. So I think for those that are considering paying off debt, especially if that debt is 5%, 6%, in that range, I think you want to start looking at paying off some of that debt. I still want you to invest, however, because I think the opportunity to invest right now, how the market has played out, and all the cheap investments that exist out there, I think you can make a lot more than 5-6% in the coming few years if you get in at this point in time. But I think you need a balance that investment, balance off paying off the debt. When interest rates were 1-2%, I was all about making as much investment as you can. Today, I think you want to balance paying off your debts, especially if they're in that 6 to 7% range. Another question here. With the end of the year fast approaching, are there certain questions I should be asking my investment advisor, or he should be asking me? I touched on it briefly earlier. I think the capital loss situation, capital loss, capital gain, if you're sitting on a very large capital gain for the year, if you have a loss in your portfolio that makes sense to take or to sell off, you can offset the gains with a loss to bring down your tax rate. So I think that's definitely something you should consider, capital gain loss selling, and we see it all the time. I also think you should look at RESPs. If you're someone watching, you have RESPs. Deadline for RESPs is the end of the month. It's on a calendar basis, unlike the RSPs. Our RSPs, which is March 1st deadline, our ESPs is calendar year. So that's something else you should be looking at. And finally, I think everybody should be looking at their portfolio all the time, trying to reassess, trying to make their portfolios better, trying to move things around, which is what I do every day, to better the quality of your portfolio. So I think you should always be looking at your portfolio, but at this time of year, tax loss, selling, RESPs are two things that come to mind that you should be considering. So with that, ends another show. I want to thank everybody for tuning in to the show this week. There'll be another last show for the year, I guess, in a couple of weeks on the 21st. I look forward to seeing all of you again, and good luck with your investing. And let's hope for a nice start to a Santa Claus rally to end the year. Goodbye.